Well, meanwhile, the Reserve Bank of India today increased inflation targets from earlier's 4.5% to 5.7%. The other aspect, GDP growth target of our projections for the current financial year has also been trimmed from 7.8% to 7.2%.
Real GDP growth for the year 2022-23, that is the current financial year 22-23, is now projected at 7.2%. I repeat, 7.2%, with Q1 22-23 at 16.2%, Q2 at 6.2%, Q3 at 4.1%, and Q4 at 4%, assuming crude oil, that is Indian basket, at $100 per barrel during the year 2022-23. Financial markets are likely to remain volatile on rising risk premia, dislocations in trade and capital flows, and divergent monetary policy responses across central banks. Taking into account these factors, and on the assumption of a normal monsoon during 2022, and average crude oil price, that is the Indian basket, at $100 per barrel, 100 per barrel, inflation is now projected at 5.7%.
Let's bring in some more perspective. Yuvika Singhal, economist, is joining us on the broadcast. Thank you very much for speaking to us. We've just seen a host of reports from our reporters across the country talking about the various aspects where prices are rising, whether obviously fuel costs, transport costs, vegetable costs. So across the board, the prices are rising. And obviously, RBI has also now increased the inflation projections by a significant margin. What is your own assessment of the situation? How worrying is the inflation scenario right now?
Hi, Avni. So we do contend with the fact that price pressures are on the uprise. We do see that in fuel costs, which are reflecting a lagged adjustment. If you would recall, for the longest period of time, almost 4 months, we did not see any fuel cost adjustments. And now we are seeing prices increasing almost on a daily basis, even by small margins, that is. And if you look at other factors, we do see food prices rising. That's largely because of the onset of summer. The winter seasonality that was enjoyed in the months of November, December, up till the month of March now stands to, erode with the onset of exceptionally high temperatures in the summer months. So, yes, price pressures are rising, and adding to these food and fuel pressures, there is also pressures coming from the core inflation front, where demand is recovering more strongly. Mobility has almost, seen new highs being set. And with consumers moving around and with vaccination gaining pace, there is a lot of demand side pull to inflation that also coming in. And adding to this, there is bound to be a second order impact of fuel inflation, which would largely work through transportation costs. And that is something that RBI also alluded to, that price pressures could become more generalized across different sectors if the second order impact was to also come into play. And that gets reflected in RBI's own assessments of CPI inflation that have gone up drastically from 4.5%. Now they are, 120 basis points up to about 5.7%. In fact, in our own assessment, we are seeing broader price pressures, and our own estimate of CPI inflation for FY23 is actually sitting somewhere between 6.1 and 6.3. That is also premised on a crude average level of 100 basis points, but we do see greater impact coming in from the second order impact of inflation. So we are still higher than RBI's assessment of CPI inflation.
Right. Yuvika, in that case, what would then be the assessment as far as growth is concerned? Because once again, we've seen the growth, projection being cut by the RBI, and with the price pressures that might continue to be at this level, if not increase, how much of a risk are we at sort of undoing all the good that has been done so far for the economy?
So it's a tricky question to answer. The impact of commodity prices, as we all know, is more direct on inflation. And when you see fuel prices rise, food prices rise, that is bound to impinge on disposable income of households. And that could have, an impact on how consumers spend going forward. So that essentially will weigh on growth. Also, in addition to the consumption angle of, on growth, there is also uncertainty as far as investment is concerned. So we, in our own assessment, were of the opinion that if this growth momentum would have continued into FY23, probably in the latter half of the year, we could see green shoots of investments coming on board, at least in some of the sectors. But with the demand looking more tentative, commodity prices seeing the kind of rally that they have over the last few months, even the investment cycle looks a bit tentative. Having said so, though, the capacity utilization levels that RBI had put out along with the monetary policy today do seem to be edging up and have risen above the 70% threshold, or that is what the benchmark levels that we look at for incremental investment. But no two ways about it that both consumption and investment look on a weaker footing, along with exports. So it's unlikely, looking at how the global economy is shaping up with most of the developed central banks sounding more hawkish, getting on more aggressive rate tightening cycles, it is unlikely that our domestic exports would see the kind of growth momentum that they have this year. So all these levers of growth from an economics perspective, consumption, investment, exports, like I alluded to, do appear to be on a somewhat weaker footing. So,
Right.
yes, there are concerns on growth which do get reflected in RBI's assessment of GDP growth getting downgraded to 7.2 in FY23.
All right, Yuvika Singhal, thank you so much for joining us with your perspective.